The market doesn't crash because people don't know what's happening. It crashes because they think they do. In 1929, some of the smartest investors in America watched their fortunes evaporate in weeks. Not amateurs, not gamblers, professionals. Benjamin Graham lived through that collapse, and unlike most, he survived it financially and psychologically. What protected him wasn't luck. It wasn't inside information. It was a set of rules so boring, so conservative, that almost no one follows them when it matters most. And that's exactly why they worked. Right now, markets feel different. Every generation thinks their crisis is unique. AI, zero commissions, infinite liquidity. But the structure underneath hasn't changed. Fear still moves faster than facts. Greed still hides behind confidence. Graham understood something uncomfortable. You don't lose money because markets fall. You lose money because you break your own rules when they do. The first rule was simple and almost insulting. Know the difference between investing and speculating. Graham didn't care what people called their trades. If your return depended on someone paying more later, you weren't investing. You were speculating. During crashes, speculation doesn't decline. It disappears. Rule 2 was about margin of safety. Not as a concept, as a survival tool. Graham bought businesses priced so low that even if he was wrong, reality would protect him. If a company was worth $1, he wanted to pay 50 cents. Not because he was pessimistic, because he knew his estimates could be wrong. This rule alone saved him in 1930. Assets collapsed. Earnings vanished. But prices had already assumed disaster. There was nowhere further to fall. The third rule was diversification, but not the way it's marketed today. Graham didn't diversify to maximize returns. He diversified to reduce regret. He assumed some ideas would fail. He planned for it. Modern investors diversify expecting everything to work eventually. Graham diversified, assuming some things would break immediately. Rule 4. Never confuse price movement with business performance. During crashes, stock prices don't reflect reality. They reflect panic. Graham taught that the market is a voting machine in the short term and a weighing machine in the long term. Crashes are when the votes turn hysterical. Weighing comes later. Rule 5 was emotionally brutal. Do nothing often for years. Graham was comfortable looking inactive while others chased recovery rallies. He knew most rebounds were emotional, not structural. Waiting felt foolish, but acting too early was fatal. Rule 6 was to distrust forecasts, especially confident ones. Graham watched economists, bankers, and newspapers confidently explain every crash after it happened. He never believed anyone could predict timing reliably. So he built a system that didn't require prediction at all. Rule 7 was balance. Literal balance. Graham insisted investors split money between stocks and bonds. Not because bonds were exciting, but because crashes don't ask for permission. They arrive when confidence is highest. Bonds were his psychological shock absorber. Rule 8 was to treat volatility as information, not instruction. Price swings didn't tell him what to do. They told him what others were feeling. When volatility spiked, Graham slowed down. The louder the market screamed, the quieter he became. Rule 9 was humility. Graham assumed he was wrong more often than he was right. This wasn't modesty. It was not. Overconfidence compounds. Losses faster than leverage. And the 10th rule tied everything together. The investor's biggest enemy is not the market. It's themselves. Graham didn't design rules to beat other investors. He designed them to protect himself from his own reactions. Here's the uncomfortable part. These rules underperform in good times. They lag during manias. They look outdated when markets are rising effortlessly, which is why people abandon them right before they need them most. The public narrative celebrates boldness, conviction, all-in bets. But Graham's reality was quieter, slower, defensive, and brutally effective across decades of crashes, wars, inflations, and bubbles. Markets don't reward intelligence consistently. They reward discipline. Eventually. And the question Graham leaves us with isn't whether another crash will happen. It's simpler and more disturbing than that. When it does, will your rules still exist? Or will you discover you never really had any at all?